Hi friends, welcome to A to Z Learning channel. Equity investing is such a mysterious world that we are all the time struggling to look for those trends which can indicate which sector to invest in, which company to buy, which company to sell. But usually we find those trends only when the time has passed when we are looking at in our rear view mirror, when we are looking at the past results, only then we see those trends, not when the time is right for you to be investing or selling a particular stock. And it's very, very important for any investor to know, even if you know the trend, what is likely to happen, you can look at the trend. Then still the question is, how do you do the right thing so that you can gain from those trends? So your wait is over. Today's video, we will discuss with you what are the long-term structural trends in equity investing, and most importantly, we'll touch on how you can gain from these trends. So it's going to be an important video. Please stay with us until the end of the video. And if you have not subscribed our channel A to Z Learning, we would urge you to subscribe our channel and become part of our viewers community. And along this video, as you watch, if you like the content that we are sharing with you, then we would again urge you to please press the like button and share this video with your friends and family. So without any further delay, let's start our video. Before we talk about what has happened, what is likely to happen in the future, it's important to kind of take stock on on the current situation. Year 2021, it's the beginning of new decade for us, and it's important to know what is likely to happen in this decade, which is starting now. But before we talk about what is in the store for the future, it's important to remind ourselves and it's important to understand what has happened in the decade, in the last 10 years that have just completed. So the period from 2011 to 2020, what has happened? It's important to quickly remind about those things. So let's start with the last decade, last 10 years. When you look back, you see those 10 years were full of challenges, but at the same time, they offered many opportunities for an equity investor to enter into the market or exit from the market and realize some interesting gain on their investment. So let me remind you about few things which will hopefully jog your memory if you have been an investor in the last decade. I think first of all, last decade, if I look at, was the one particular thing that stands out is that most companies started to shift towards an asset light model. The banks became more of a fintech companies. Technology companies started to drive some of the traditional businesses, and we've seen in many businesses, for example, Reliance, which was in a heavy asset business from oil to consumer business, they moved to the Geo, which is totally a technology kind of platform for them. And that you have started to see in all the businesses. Most businesses, I think, are becoming technology company first, and then whatever is their kind of other kind of core capability competencies in terms of their business. So it's becoming very, very asset light model. Corporate profitability, when you look at 2020, it hit the rock bottom of last 20 years. It was only corporate profitability as a whole was only 1.8% of India's GDP, which is which is the lowest it has seen in last 20 years. I know a lot was due to pandemic and all that, but still 1.8% as a corporate profitability level was very, very low in 2020. Interest rates. At the beginning of the last decade in 2011, they were hovering around 8.5%. This is based on 10-year government securities yield. So 8.5%, but they were down to 6% in 2020. And that's again a record low that we have seen as an investor. Several crises we saw in the last 10 years. If I think about 2013, when the tapering tantrum started, tapering tantrum was basically on the back of 2008 financial crisis. The quantitative easing, digitally government around the world printed money to support the consumption, to support the growth. And in 2013, first time people started to talk about tapering it, means reducing it. And that led to a major crisis. Markets were kind of all over the place globally, including India. Then crisis of our own doing in India, demonetization in 2016, that led to kind of panic in the market, and markets were again all over the place. And and last one to kind of just give you an example is the pandemic in 2020. You saw the markets went down to historical low level in the March April period last year, and but we have seen the bounce back in 2020. So there were several macro level crises that we as a country, we as a stock market saw in the last year. In spite of all this, when I look back last 10 years of Indian stock market, they did deliver, most of the frontline indices delivered 8 years of positive return. There were only 2 years when on an annual basis, the returns were negative for the frontline indices. So again, 8 out of 10, great performance. Equities as an asset class also topped in spite of all these crises, in spite of 2020 pandemic. Equities delivered a 10.2% compounded annual growth rate in the last decade, which was the best amongst the other comparable asset classes like gold, which was only 9.3%, bank FDs and government securities. So the debt delivered on average only about 7.6%, but equities stood at 10.2%, which was the best. So overall, it's good to kind of be reminded about that. So with all the kind of challenges and opportunities, overall, there were many kind of good things while recognizing the fact that there were many down point also in the last decade. And that's true with any long period that you look at. You see the goods and the bads. As long as you have a fair share or more of a share of good things, then you've done really well in terms of your investment. But past is past. Important question right now, and the information is what is the trend for the next 10 years, so that you can make your portfolio immune to any surprises. You can kind of structure your portfolio, you can structure your investment in a way so that you're more on the right side, more on the good things for next 10 years than on the things that will bring your performance, bring your return down. So let's now move to the next section where we touch in terms of what are the trends for the future. So here, as I said, that we will be focusing on the structural trends in equity investing. What are the key themes that are emerging? What are the key themes that will play a major role in terms of driving the return for the next 10 years? And as long as you are aware about that and you are kind of searching, hunting for those areas, hunting for those companies which are in those kind of trending areas, and investing in those, you are likely to gain from these structural trends that we foresee in the future. First major theme that I see is that this wave of digital and tech companies will continue. They have already benefited on the back of pandemic. Suddenly, most corporates, most businesses move from working from office to working from home 100%, and it's tested the technology infrastructure that company had. But that has proven, the tech companies have proven that they can withstand any crisis that come their way. So the digitalization of businesses and tech companies playing an important role to achieve that, important role to help companies and industries achieve that, is going to get strengthened and strengthened. So for next 10 years, I do see the trend in favor of digital and technology companies. Which are the companies that could benefit from it? Usual names: Infosys, HCL Technology, TCS are absolutely well placed with their diversified footprint, diversified product portfolio. They are going to benefit. But don't forget about upcoming companies like L&T, Mindtree, your Happiest Mind. These are also kind of great companies which have got great growth potential as the digitalization of the various industries take the pace, take the momentum in the next 10 years. ESG philosophy is going to be another important theme for the future. It will guide all long-term investment decisions from the mutual fund, foreign institutions, even the corporates when they are looking at investing their money, they will look for opportunities which are guided by ESG philosophy. What is ESG philosophy? It's basically the companies which are in the business that support the environment, that support the social commitment, and that support a true governance, pure governance mechanism. So these ESG philosophy are going to kind of play a very, very important role. And we see in our market, for example, ITC, which is in a tobacco business, which is not seen environment friendly, which is not seen socially good. It is on the receiving end, but ITC as a management team, they are kind of actively working towards diversifying their revenue portfolio, diversifying their business, and that's the reason they're going big in the FMCG, they're going big in the hotel business, and hopefully over time it will have more of a balanced portfolio where tobacco business will not be the kind of main driver of their revenue and profitability. And it's important to keep these kind of ESG philosophy in mind as you look for companies who you are kind of picking up for investment. Companies that are more ESG compliant are likely to give you better return. And that has been proven in the recent past. If you look at the last 3 years return or 5 year return, ESG philosophy companies have delivered slightly better return than the normal um, companies. So that's we predict going to be an important theme for the future. Emerging markets where India comes, China comes, Brazil, African countries. So there are a number of emerging markets. They had a torrid time in the last decade. When you look at in dollar terms, they offered or they delivered return of only 1.2%. But they are now set up to really bounce back. I think next decade is going to be very, very important for emerging markets, and they are likely to deliver better returns in dollar terms because dollar is weakening, growth is returning in the emerging markets. Um some of the kind of developed markets are struggling with the pandemic and post-pandemic implications. So taxes are going to go up. Corporates may find it difficult to attract the talent in those economies. So emerging markets are well placed to leverage, well placed to benefit from all the growth that will be delivered to the world economy. And therefore, I believe that they are all set to kind of bounce back in the next 10 years. Then I think the fourth theme is the disruption theme, which is important. You always need to look for, you always need to have that nose to smell where the disruption is taking place. Disruptors will always give you the return which is unthinkable, unimaginable. And there are a number of kind of opportunities which will come your way because the global ecosystem is fast developing. There's a lot of funding and investment coming in the India startup ecosystem, and that will give you many companies which will be the future of maybe Infosys, Facebook, Netflix sort of companies. So keep an eye on the companies which are really disrupting the industries in which they are operating. Some of the names that I feel really strong about: Grofers is a online retail store, grocery store, is a key disruptor. It will disrupt the way we buy our groceries. It's already kind of making the impact in some of the main cities. I think that's going to grow. Zomato in the food delivery kind of platform, it's amazing. It's attracting huge amount of investment from marquee investors around the world. It's all set to kind of give you better return in the future. Geo platform, we've already seen some of the trends, but I think still a lot need to be kind of tapped in terms of geo platform. So again, future return looks very, very promising. Paytm is the other example, which is a fintech company. Paytm has the potential to disrupt many kind of financial businesses, uh, and it will force those businesses to really rethink their business model. So overall, again, don't go by just this name and tomorrow write a check and invest in this company. These are just the example to make the point that always look for the disruptors and be open to invest in those companies which are disrupting the industry in which they are operating. And the last point, which is the most important point you always have to have in mind, is that you need to be always disciplined. All these themes will present you opportunities to invest in number of companies, but you need to always keep in mind the basics of disciplined investing. What are those? Always look for companies with strong fundamental performance. Whatever is the key business metrics that you're looking at that is attracting you to a company, make sure that that's fundamentally giving good performance. Always look for a company which has got the clean management team, clean founders. Don't stay away from people who are looking for shortcuts, looking to use the regulation to their advantage to make quick gains. Stay away from that, because some of the disrupting companies, when you look at, they'll have very limited time period that you can analyze for. So it's very important that you are investing in the companies which are in the right hands, which are in the hands of people who have got high standards of value system and ethical investing. So it's very important to look for that clean management. Market leadership in their product and service portfolio is again another important thing that you need to kind of always keep in mind. And most importantly, don't put all your investment in one asset class, one particular company or one particular industry. Always try to have a diversified approach, diversified your risk, because when you look for, say, five disrupting companies, probably one or two are going to fail terribly because they will never take off. But two, three that will take off will give you amazing return, and that will more than compensate you for the losses that you have made on the things that have gone wrong. So therefore, diversification is the discipline, most important discipline that you need to keep in your investment approach. So I hope you found this information helpful, and you've kind of picked up some ideas from this. If you really like the content, then please press the like button and share this video with your friends. And one last thing to kind of say is that if you've not subscribed our channel, please subscribe our channel A to Z Learning. Become part of our viewers family. We always pick up the topics of our future video based on what our viewers want us to do. So please become part of our viewers family by subscribing our channel and drive the agenda for future topics. Thank you so much for watching our video.